we'll look at economic developments over the past year. GDP grew a healthy 2.8% in the third quarter of 2016, and housing starts, a leading indicator, grew 23% from last year, suggesting continued strong growth in the future.
Moving to the labor market, employers posted 5.5 million job openings in September, a slight uptick from August with 5.4 million. Furthermore, layoffs fell to record lows of 1%, even as the total separation rate remained unchanged, suggesting an increase in employee confidence in the labor market as they search for work. Additionally, this month's job reports show average hourly wages, a lagging indicator, grew by 2.8% over the past 12 months, the largest increase of any 12-month period since July 2009.
Some signs of slack remain. While headline unemployment has held steady at or slightly below 5% for the past 12 months, close to the median FOMC long-run forecast of 4.8%, the labor force participation rate remains subdued. Currently at 62.9%, the LFPR has still barely recovered from its recession low.
The CEA and Aronson et al. In a 2014 working paper estimate more than half of the reduction in labor force participation can be attributed to the aging out of the baby boomer working population. This structural change, for better or worse, does not indicate slack that the Fed can easily counter with expansionary policy.
The job recovery seems steady, though, among young people. The LFPR for 25 to 54-year-olds at 82% has recovered more than half of the losses of the recession.
And current labor force non-participation may be a residual of discouraging labor market conditions a few years ago, rather than an indication that today's labor market is still unwelcoming. Seasonal hiring of part-time workers is far higher than this time last year, indicating a tighter labor market where employers secure work earlier in anticipation of higher wage pressures. The Conference Board's Consumer Confidence Survey shows that the percent of people who feel jobs are hard to get has fallen by 50% since 2010. This also suggests that early fears of hysteresis have been overblown.
We see longer-term potential risks internationally that merit increased supervision from the Fed. Initial indicators from large foreign economies look good. Chinese quarterly real GDP grew at 6.7% in Q3. The EU posted a steady, if unimpressive, 1.6%. Japan had growth of just 0.8% year over year. However, they recently posted a surprisingly strong annualized 2.2% quarterly growth.
However, foreign central banks have continued to take stimulative measures, leading to large capital outflows and an appreciation in the dollar. Reductions in U.S. net exports from 2012 on may in part reflect this. This is important to keep in mind as the Fed considers contractionary policies that would accelerate dollar appreciation.
In financial markets, we see few immediate concerns. Over the past year, according to ATTOM's Q3 2016 U.S. Home Equity and Underwater Survey, loan-to-value ratios have fallen, with a 14% increase in the number of homes with fewer than a 50% loan-to-value ratio, and a 12% drop in homes with an LTV of over 125%, suggesting little risk of a future housing crisis. Furthermore, all U.S. financial institutions passed June's financial stress tests, with only Deutsche Bank and Santander failing, suggesting that overall, the financial sector remains sufficiently capitalized for future financial crises. Turning to the bond market, we note that 30-year Treasury yields jumped 19 basis points overnight after the election. In addition to reflecting inflationary concerns and an expectation of future short-term rate rises, this yield increase may represent a higher implied default risk.
Turning our eye to the other prong of the dual mandate, inflationary pressures have been on the rise. Core PCE grew at a 1.7% annualized rate in Q3 of 2016, which is up from a 1.3% rate just 1 year ago. And core CPI is at 2.2%.
While core PCE is still below our 2% target, we expect that it will continue to rise. There's reason to believe that even core inflation measures have been indirectly dragged down by depressed energy prices. In the third quarter of 2015, for example, low energy prices depressed core PCE inflation by as much as 0.4%, according to a 2016 Kansas City Fed study. Now, trend energy prices are rising considerably. In October, the BLS reported a monthly increase of 3.5% across all energy categories, and a 7% increase specifically in gasoline. Based on a 2011 Kansas City Fed's research report, a change in energy prices is passed on to production costs and eventually the prices of other items with a lag of, on average, 3 quarters. Based on their VAR model, we expect an oil-driven increase of 0.26% in core PCE over the next 3 quarters, pushing us approximately to our inflation target of 2% by Q3 2017.
Our prediction aligns with the Philadelphia Fed's survey of professional forecasters, as well as the FOMC participants' median forecast from earlier this year. Both projected core PCE would reach at least 1.9% by 2018.
The election has significantly changed this outlook in a few ways. Inflation expectations shot up further. The break-even inflation rate implied that a 10-year tip spread increased 24 basis points in just the past 2 weeks, now standing at 192 basis points. And this is in spite of increasingly confident expectations of an FFR rise in December, to which markets assign around a 95% probability according to Fed funds futures.
But are the markets correct in expecting more inflation from the Trump administration? We broke down new inflation considerations. On the side of decreased inflation, we see the prospect of deregulation in the energy sector, increasing U.S. oil output and driving energy prices back down. And a proposed reform of taxes on foreign profits may cause companies to repatriate cash, giving the dollar a short-term boost.
On the side of increased inflation is the President-elect's vow to invest $1 trillion in infrastructure while cutting taxes. An increase in deficit spending and a greater amount of public debt leads to demand-pull inflationary pressure. We expect that this pressure will overwhelm any supply-side effect coming from infrastructure investment.
On balance, we side with the market view that the election increased inflation prospects. Given that prior to the election, the economy seemed ready for normalization, we remain comfortable advocating tightening now.
This brings us to our proposal. The simplest action would be to increase the FFR target range by 25 basis points. This would be a step in the direction of following a strict Taylor rule, which instructs that nominal interest rates be set at 2.8%, giving equal weighting to inflation and output gap coefficients.
However, we see an alternative that makes use of the Fed's large balance sheet. To provide context, in the aftermath of the financial crisis, the Fed's balance sheet swelled to historic levels. Assets increased from $870 billion in August 2007 to more than $4.5 trillion today, driven by the Fed's large-scale asset purchase programs. The Fed's normalization plan currently entails replacing expiring assets with assets of shorter maturities. The FOMC has indicated that eventually it will gradually cease reinvestment and payouts for matured assets so that the balance sheet will return to pre-crisis levels.
We don't see the exigence for reducing the size of the balance sheet. Instead, we believe the Fed has an opportunity to use the large balance sheet as a policy tool. We suggest 2 simultaneous programs, a reverse operation twist and an expansion of overnight and term RRP issuance. Together, these will have a similar contractionary impact to a 25 basis point increase in the FFR, while simultaneously addressing macroprudential issues that the Fed has been tasked with since Dodd-Frank. We'll go through each of these 2 programs in turn, while our slides visually demonstrate their effect on the yield curve.
First, a reverse operation twist, similar to the program announced by the Bank of Japan. In our program, the Fed would sell 10-year treasuries currently on the balance sheet and buy an equivalent amount of 3-year T-bills on the market. Through the portfolio balance effect, this would increase long-term interest rates and decrease short-term rates, causing the yield curve to steepen. The red line in the diagram above indicates the new yield.
Second, the Fed raises offering rates on repurchase agreements ranging from overnight to 65 days to increase RRP take-up, while raising the cap for this facility, as has been suggested by former Fed Governor Jeremy Stein. This increases the supply of short-term securities and raises their yields, offsetting reverse operation twist's reduction in the supply of short-term securities.
The net effect is that short-term yields stay approximately the same while long-term yields increase.
Our policy has a few advantages over an FFR rise, as well as a few drawbacks. Beginning with the advantages, we first note that it will steepen the yield curve. It will become more profitable for firms to finance long-term investments by issuing short-term debt. This additional profitability will incite firms to expand their role as financial those who do so to break even without imposing so many costs on lending. This will increase liquidity in the bond market, according to the Bank of Japan's comprehensive assessment. We believe this is an important step towards normalization, since liquidity in the bond market has declined as a result of term compression in the past 8 years, accentuated by the maturity extension program implemented in 2012.
Additionally, increased returns from safe investments like long-term treasury securities decreases the incentive for firms to engage in risky profit-seeking behavior. Becker and Ivashina argue in a 2013 working paper that banks and insurance companies reach for yield by making riskier investments, especially in prolonged low-rate environments or during economic expansions. By offering comparatively higher long-term yields, we discourage riskier investment in short-term assets, for example, in the commercial paper market.
Beyond steepening the yield curve, our policy would also directly crowd out the market for commercial paper and shadow bank activities like repos that are run prone. Sundaram 2013 argues the strong demand for, quote, money-like assets, including commercial paper, contributed to the growth of shadow banking in the lead-up to the financial recession, with devastating consequences. Greenwood, Hansen, and Stein 2016 argued that the Fed can fight back by offering more safe short-term treasuries through an expanded reverse repurchase program. Money market funds in particular will substitute commercial paper for our RRP agreements, which have a comparable term to maturity.
There are, however, some concerns associated with this proposal.
First, maintaining a large balance sheet increases exposure risk for the Federal Reserve, which Sims 2016 warns could ultimately affect the government's overall fiscal position. However, our policy reduces the proportion of long-term assets on the Fed's balance sheet, which Greenwood et al. Argue will have the same effect of insulating the Fed from interest rate risk.
Next, we do acknowledge that by not raising interest rates now, there is less of a buffer for the Federal Reserve to drop interest rates in case of another economic recession, which would necessitate promulgating policy.
Finally, perhaps the biggest risk is the novelty of the idea and the current lack of data on potential secondary impacts, with the Bank of Japan's yield curve control announcement still recent and Stein's proposal not previously implemented by a central bank. However, we believe the benefits of our policy outweigh the possible costs.
We'll now discuss the implementation of our policy. First, to expand the RRP program, we would reintroduce term RRP and increase overnight RRP take-up. To increase overnight RRP take-up, we would need to slightly increase the offering rate. We wouldn't, however, raise the IOER or the FFR. There is currently a 25 basis point wedge between the ON RRP rate and the IOER, so we would simply tighten this wedge. If necessary, we would then increase the 30 billion ON RRP and historic term RRP caps so that we can fully offset our purchase of short-term instruments and reverse operation twist. We would continue to use Treasury securities as RRP collateral, noting that historical usage of the RRP program has never come close to exhausting the system open market accounts available treasuries.
We should have in mind the scale of transactions that will be necessary to have a contractionary effect equivalent to a 25 basis point increase in the FFR. We used the model published by Gagnon et al. In the 2010 New York Fed staff report, the details of which can be found in the appendix to this presentation. From this, we estimate that a 25 basis point increase in 10-year yields can be achieved through reverse operation twist of selling $700 billion worth of 10-year treasuries. In conjunction with our equivalent purchase of 3-year treasuries and RRP expansion in order to keep short-term yields constant.
Our estimate of $700 billion is, if anything, biased downward slightly, since a 25 basis point increase in long-term rates may have less of a contractionary impact than the equivalent increase in short-term rates, according to Sims et al. 2016, Swanson et al. 2011, though they cannot estimate the precise difference. We're comfortable with this, since the greater risk would be a policy that ends up overshooting in its contractionary impact.
After its December meeting, the Fed can provide forward guidance that leaves room for future discretion, but stays in line with current market expectations, reflected by Fed futures that rates will rise next in July 2017. And going forward, the Fed can continue to tighten by increasing the FFR. We will do so, however, from a better position, having taken this opportunity to implement contractionary policy with macroprudential benefits.
Thank you for listening, and we're excited to field any questions you may have.